Hello friends, how are you? I hope all of you are doing really good. So welcome to Economics or Finance Excellency batch, and in this lecture we are going to start with our new topic, that is chapter number 9 on monetary policy. Okay, so a lot of students have been asking me that, sir, will we be able to complete the syllabus for May 23? Yes guys, as promised, within March only we are going to complete the syllabus, so nothing to worry as such, right? We are going on time, and just my advice is keep revising side by side. All of you must be having the books, right? And still, if you're not having the books, I will advise you to please go and get the books. That is really important for all of you, right? Because that will really help you guys in the revision time to quickly revise all the topics and understand them. So it is really important. Okay, right, sir? So let's start with our new topic, that is the monetary policy. So we studied about the money demand and the money supply. That, sir, what is money demand and what is money supply? Now they say that in case you want to control that money demand and money supply, obviously there will be times when you will need to control the money demand and money supply, and there will be times when you need to decontrol that. Decontrol means you need to loosen out the things, right? You need to increase the money demand as well as the money supply. So how is it done? They say that time to time the various policies are made for controlling the money demand and the money supply, right? Basically, what we are trying to do is, under the different situations of the economy, if there is inflation, if there is recession, the whole game that we have to play is around the demand, right? And to control the demand, we need to control the supply also, the money supply, right? So what are the various policies, what are the various instruments which are available with the Reserve Bank of India, with the central bank, as well as with the governments to control this demand and supply? That is what we study in this chapter of monetary policy, right? So I've just given you the overview crux of the chapter, that what this chapter talks about. Now let's see the concept of monetary policy. We say the monetary policy is the macroeconomic policy laid down by the central bank, right? So that means these policies are not created at the small levels. These are created keeping in view the whole economy into picture, right? That is why these are known as the macroeconomic policies. That is, these are created for the whole economy, the whole country. After that, we say that it involves management of money supply and interest rate. And what is the purpose of the management of money supply and interest rate? To control the money demand, right? And is the demand side economic policy used by the government of a country to achieve the macroeconomic objectives like inflation, consumption, growth, liquidity, etc. So all these parameters, if we talk about, let's talk about inflation, sir. Now inflation, if there is inflation, it is going to hit the whole economy. It is not going to hit the particular sector, or it is not going to hit a particular city, state. It is going to hit the whole economy, sir. So that is why the policies are made, right, with the help of the management of the money supply and the interest rate to control the money demand to achieve what? The macroeconomic objectives, right? In India, the monetary policy of the Reserve Bank of India, and who is creating this monetary policy? Sir, the Central Bank of India is creating the monetary policy, right? Is aimed at managing the quantity of money. Quantity of money means the supply of money, right? In order to meet the requirements of the different sectors of the economy and to increase the pace of economic growth. Now, to meet the requirement of different sectors means that how the money supply should be there, how the money distribution should be there, right? So that it is not concentrated only in the hands of few, it is equally distributed, right? If the money is equally distributed, only then we can expect the economic growth. So he says the RBI implements the monetary policy through various instruments like the open market operations, bank rate policy, reserve system, credit. We are going to study all these instruments, right? Nothing to worry as such, that there are various policies, various instruments through which these policies are implemented. Okay, using any of these instruments will lead to changes in the interest rate or the supply in the economy. Supply of what? The supply of money in the economy. So he says whenever there is a policy, right, through these instruments we implement the policy, and what is the impact? Either there are interest rate changes or there is the change in the supply of money in the economy, right? Example, to maintain the liquidity in an economy, the RBI is dependent on the monetary policy by purchasing bonds through open market. This we will study, right, in this chapter as we we'll move on in this chapter. We are going to study whole of this part, right? That what are the various instruments, how the this central bank takes into account the changes in the monetary policy affect the supply of money, the interest rates. The ultimate goal is that you need to control the demand of money, right, to meet the various macroeconomic principles, right? So what are the objectives of the monetary policy? The objectives, primary objectives are the price stability. Obviously, sir, this is one of the major objectives, the major factors. This price is one of the major factors, sir. Increase in prices, inflation. Decrease in prices, decrease in demand, decrease in prices, recession. So if the prices are stable, that means the demand will be stable. When the demand will be stable, these inflation and recession conditions will not come, and the economy will grow with stability, right? So he says the stability is one of the major objectives of these monetary policy. So Keynes suggested that the price stabilization is the main objective of the monetary policy, right? Stable prices reports the public confidence because the cyclical fluctuations are totally eliminated. Now, if the prices are stable, even the public feels safe and secure, right? Cyclical fluctuation means the periods of inflation and recession, these are not there. It promotes the business activity and ensures the distribution of income and wealth. Obviously, when there is price stabilization, the people's demand will be stable, right? Demand will be stable, so the business activities will flourish because there is no inflation, no recession, there are no fluctuations. So the businessman also feels safe and secure that they can do the business in whatever the way they want, right? And obviously ensures the distribution of income and wealth. Basically, what we say is it leads to the overall economic growth. So as a consequence, there is a general wave of prosperity and the welfare in the community, right? So this we can write it as overall economic growth, right? This is what we call it as overall economic growth, right? Any doubts in this thing? I hope this much is clear. So he says another objective is economic stability, the maintenance of full employment and the achievement of the high level of economics growth. Obviously, sir, one of the major objectives of any monetary policy is aimed at what? Aimed at the full employment, the stability of prices will be there, the demand will be stable, the businessman will flourish, and if the businesses are flourish, there will be high demand for the employment, and when there is employment, there will be equal distribution of income and wealth, which will lead to the overall economic growth, right? Which will lead to the overall economic growth. Clear? Then we say the other objectives: rapid economic growth, debt management, moderate long-term interest rate, exchange rate stability, adequate flow of credit to the productive sector, stability of the long-term interest rates to encourage the investment, and the creation of efficient market for government securities. Just go through it once, right? Nothing as such to worry about it, right? Just go through it once. Clear? Then this was the basics of the monetary policy. Now there are two different topics that we have to study in the monetary policy. One is the analytics of monetary policy. Then we will study about the instruments, that is the operational channel, right? That is operating procedures, right? So two major things that now we are going to study in this part. The one is the analytics of the monetary policy, that how we analyze the various monetary policy instruments, right? And what are the various ways in which we can do that. Then there is operational procedures, how really the implementation is done in that, right? First we are talking about the policies, right? What can be the different policies, then we will talk about the various instruments to implement those policies, right? So when we are talking about the various policies, that is analytics of monetary policy, that how the various policies can be framed, right? And what will be the response of those policies on the money demand, money supply, and the interest rates. Clear? So first we are going to talk about the analytics of the monetary policy. The analytics of the monetary policy focuses on the transmission mechanism. Now what is this transmission mechanism? It says the process or the channels through which the change of the monetary aggregates affect the level of product and the prices is known as monetary transmission mechanism. That if you change any of the monetary aggregates, right, if you reduce the money in the hands of people, that is what? That is a change in the monetary aggregate, right? If you reduce the money that is available with the public, then what will happen, sir? Sir, the demand will come down, When the demand will come down, the production of the product will come down. Yes, sir, it will affect the level of the production. And when the level of the production is down, the demand is less. What will happen to the prices? The prices will also crash. The prices will also come down, leading to a recessionary period, right? So if you change any of the monetary aggregates, what will be the impact? This process of the change of the monetary aggregates and their impact on the level of production and the prices is known as monetary transmission mechanism. Clear? So you need to remember this because this can be as such asked in the examination. You need to remember these small terms, right, which are very, very important. It describes how the policy induced changes in the nominal stock of money or in the short-term nominal interest rate impacts the real variables such as the aggregate output and the employment. That is what I just told you, that due to certain monetary policies, if you are trying to reduce the money in the hands of public, then the demand will be less, the production will be less, and if the production will be less, obviously the employment level will also come down, because the factories who are manufacturing, they will say we no longer need too much of the labor, too much of employment. Let's reduce our labor force because we need to reduce our expenses. The demand is not that much for the products, right? So there are mainly 4 different mechanisms through which the monetary policy influences the price level and the national income. One is the interest rate channel. One second guys, one second. The first one is the interest rate channel, then the exchange rate channel, the quantum channel, that is relating to money supply and the credit, then the asset price channel via the equity and the real estate prices, right? So the manner in which these different channels function in a given economy depends upon the stage of development of the economy and the underlying financial structure of the economy, that whether it is a developing economy, whether it is a developed economy, based on that the various policies will work, right? And what is the financial structure of the economy, whether financially strong or whether financially not strong, right? So all these things matter and all these things will be considered while setting up the various policies, right? Now let's discuss about these various mechanisms which are given. That is, the interest rate channel is given, the exchange rate channel, how they impact the price level and the money demand and supply, right? So what is interest rate channel, sir? Very simple, very simple. Now what is there? Mr. X, let's try to understand this interest rate channel, right? Now there is Mr. X, right? And he approaches a bank for a loan. He approaches a bank for a loan of 1 CR, right? The bank says, okay, we are ready to give you loan and the rate of interest will be 10%, right? Mr. X says, okay, I'll pay you 10%. Now after a few months, again he approaches the bank. For a loan of another 1 CR. The bank says, okay, we'll give you loan, but this time the rate of interest will be 15%. Now Mr. X says, sir, I have taken a loan a few months back only. At that time it was 10%. Now why are you charging 15%? The bank will simply say, because of the change in the monetary policy by the central bank. Now will Mr. X take the loan at 15%? No. Now Mr. X will say, let's do what? I'll take 50 lakhs only, right? Let's say at 15%, he will cut down on his requirement of the money, right? Earlier, he wanted, the demand of the money was 1 crore. Now he is demanding 50 lakhs only because of the increased rate of interest. Now what will happen, sir? What will happen here? The money demand will fall. Money demand will fall, right? Now if there is less demand of the money, overall demand will fall, right? Because people have less money in hand. Now overall demand will fall. When the overall demand will fall, what will happen, sir? The prices will come down. Now when is this situation helpful? This situation is helpful in the conditions of inflation, when you want to control the money, when you want to reduce the money in the hands of public, right? So a contractionary monetary policy, contractionary means you need to reduce the money supply, you need to reduce the money demand, you need to reduce the money that is available in the hands of the public. So this is done during the period of inflation. A contractionary monetary policy induced increase in the interest rates, That is what we discussed here. This is policy induced increase in the interest rates. increases the cost of capital. Cost of capital means this part, this is your capital, and this 15%, this is your cost of having that capital, right? We have studied in the chapter of cost of capital in the financial management also, right? Capital is what? Capital is the money that you want to use, and cost is the money that you need to pay for using that money, right? So, and the real cost of borrowing for the firms, with the result that they cut back on their investment expenditure. Earlier, Mr. X was asking for 1 crore. Now he says, okay, I'll cut down on my expenditure. Just give me 50 lakh rupees, sir, at the rate of 15%. Why? Because the interest rate has increased. He says, my cost has increased. If my cost has increased, how can I control my cost? I will cut down on my demand for money from 1 crore to 50 lakhs, right? An expansionary monetary policy, on the other hand, on the contrary, the vice versa, the expansionary policy, this is done during the periods of what? During the period of recession, right? The expansionary monetary policy induced a decrease in the interest rates will have the opposite effect through decrease in the cost of capital for the firms and the cost of borrowing for households. And the now if Mr. X, this interest rate falls from 10% to 8%, now Mr. X says don't, now Mr. X will say what? Mr. X will say don't give me 1 crore, right? Don't give me 1 crore, at 8% give me 1.5 cr. Why? Because the interest rates have fallen. He can say, Mr. X will say, I can have more money in hand. More money in hand means more demand. More demand means overall increase in the demand, overall increase in the prices, and the economy will come out of recession. So this is basically a circle that keeps on continuing, sir. In case of inflation, we try to control, we try to reduce the demand, and in case of recession, we try to increase it, right? So it's a vicious circle that keeps on continuing. And if that becomes stable, if the prices are stable, the demand is stable, everything is stable, then we say the economy is in stability. But in reality, it doesn't happen. In reality, as we say, it doesn't happen. That is why the monetary policies are prepared from time to time. Right, sir? Okay, after that we say the households facing the higher real borrowing cost cut back on their purchase of home, automobiles and all types of durable goods. Obviously, the same case is with the household also, right? Let's say you want to go and buy the Mercedes, but if the rate of interest is very high, you will cut down on your expenditure. You will say, okay, I don't take Mercedes, I will take some car which is the cheaper one, right? The Mercedes was costing 1 CR. Now I'll say, okay, because the rate of interest is very high, I cannot bear that cost. So you will say, I will buy a car which is worth 30-40 lakhs, right? A decline in the aggregate demand results in the fall in the aggregate output and the employment. That if the demand is less, the production will be less. The less production means less output, right? And accordingly, the employment will also be on the lower side. Clear? After that, we have the exchange rate channel. What is this exchange rate channel, sir? Exchange rate is the foreign exchange rate. We all understand, sir. The exchange rate channel works through the expenditure switching between the domestic and the foreign goods. Expenditure switching between the domestic and the foreign goods. Appreciation of the domestic currency makes the domestically produced goods more expensive compared to the foreign produced goods. This causes the net exports to fall. Correspondingly, the domestic output and the employment also falls. What does it mean, sir? Now he says, let's say there is a foreigner, right? Mr. John from USA. Mr. John from USA. He visited India on 1st of April 2023. Let's say on that particular date, what is the currency rate? That is $1 is equal to, let's say, rupees 80. Right? He visited India. He went to a restaurant to eat something, right? Food. Now he can have food for 80 rupees. Let's say he has $1 in his pocket, and what he is buying, sir, for 80 rupees, what he can buy? Let's say he has what we can say, sir, what does he want to have? Let's say he has a snack, any snack, sir, whatever he wishes to have, right? Any snack worth 80 rupees because that was what he liked. Now for that 80 rupees, he is paying $1. That means he is spending $1 rupees, right? Now he went back to USA. He was very happy, very, satisfied by eating this. Now he again visited India on 30th of September 23. At that particular point of time, this dollar rate was worth 70 rupees. Right? Now he again visited the same restaurant and he ordered the same snack. The snack rate is how much? 80 rupees. Now can he buy it with $1? No, sir. Now he will have to shell out more than $1. Now he will have to shell out more than $1. That means this is the appreciation of the home currency which will make the exports costlier. Right? Because when you are going to export something, earlier that person was paying $1 for 80 rupees. For 80 rupees, now he will have to pay more than $1 for the same product. So exports will become costlier. On the other hand, the imports will become cheaper. This is the impact of the exchange rate channel. So what will happen here, sir? If you talk about the exports, exports will become costlier. Exports will become costlier and the imports will become cheaper. Imports will become cheaper. Right? Now, when the exports will be costlier, there are firms who are mainly dealing with the export of the goods. Right? So, overall demand will be less. Demand will fall. When the demand will fall, the prices will fall and the employment will also fall. Employment will also fall, isn't it? So this is what the exchange rate channel says. Appreciation of the domestic currency makes the domestically produced goods more expensive compared to the foreign produced goods, and this causes the net exports to fall. Correspondingly, the domestic output and the employment also falls. Right? So I've explained you with the help of an example. Clear? Okay, next moving on to the third channel, that is the quantum channel. Quantum channel means relating to money supply and the credit. Bank lending channel. The credit channel operates by altering the access of the firms and households to the bank credit. Now, we discussed about the money supply, and in that we discussed about how the commercial banks create the money supply. How the commercial banks create the money supply? Through lending, through borrowing and lending. This is what we discussed about. So we say that if these banks want to control the money supply, how can they do that? Sir, they will reduce the money that is available for the lending, right? So the credit channel means the bank, the commercial banks can give the credit, operate by altering the access of the firms and household to the bank credit. Bank credit means the bank loan, right? An open market operation that leads first to contraction in the supply of bank reserves and then to the contraction in the bank credit requires the banks to cut back on their lending. This we'll study later on, the open market operations, how the government is basically what this RBI is doing in the open market operation is what RBI is doing. Let's say what RBI is doing is, this is the open market, right? Here there are many people who are operating, right? There are hundreds of people who are operating. They have the bonds, right? Or any investments. Let's say this is 1 CR. Now what the RBI will do? What RBI will do? Okay, they don't have the bonds, they have money in hand. Sorry, they have money in hand, 1 crore. RBI is having the bonds. What RBI will do? RBI will sell bonds to these people. The result will be this 1 crore will flow back to RBI. Isn't it? RBI is selling the bonds and RBI says, give me 1 crore. What is the purpose, sir? The major purpose is RBI wants to pull this money out of the market, right? The lesser money will be available with the public, lesser will be the deposits of the commercial banks, and lesser will be the money that is available with the commercial banks for lending purposes. This is your open market operations. This in turn makes the firms that are especially dependent on the bank loans to cut back on their investment. Obviously, if the bank credit is available in less quantity, the firms who are dependent upon those bank loans, they will have to cut back on their expenditure. Now, more money is not available to them. Thus, there is a decline in the aggregate output and employment. right? So this is the bank lending channel. Another one is the balance sheet channel. The balance sheet channel says, as a firm's cost of credit rises, Mr. X if borrowing at 10% and if it increases to 15%, this is the cost of credit. The strength of the balance sheet deteriorates. Obviously, sir, if he's taking more and more of loan at the higher rates of interest, the balance sheet of the firm will be impacted negatively. So increase in the interest rates will have the following effect on the balance sheet, direct effect. An increase in the interest rates leading to an increase in the payments. Obviously, the higher interest rate means more payments and that will reduce your profits, right? That the firm must make to repay its floating rate deposits. In the profit and loss, we say the interest on the loan, isn't it? What is the indirect effect? By reducing the capitalized value of firm's long-lived assets. Sir, obviously, ultimately what you will have to do, you will not be you are not making your own assets. The value of those assets will keep on deteriorating because you have to repay the loans also. There will be no cash in hand, there will be no money in the bank because you are paying the major part in the interest rates and in the repayment of those loans, right? So this is how if this increases, if the rate of interest increases due to the monetary policy, this is how that can impact the business directly. The balance sheet of the business is impacted, right? So last one is the asset price channel. The asset price, the standard asset price channel suggests that the asset prices respond to the monetary policy and consequently affect the output, employment and the inflation. A policy induced increase in the short term nominal interest rate makes the debt instruments. Asset here means, what does asset here means? The asset here means debt, equity, all these assets, the investment assets, right? So he says increase in the short term nominal makes the debt instrument more attractive than the equities in the eye of investors, leading to a fall in the equity prices. Obviously, sir, if there is increase in the interest rate, so the people will say that we will invest in the debt, right? We will give you the money because it is going to give us the higher interest rate. The equity investment will be less, so the equity prices will be low, right? Because the people will be interested in giving the debt, right, as they will be getting the higher interest rate. The vice versa is also true. If the stock prices fall after monetary tightening, it leads to reduction in the household financial wealth. Obviously, sir, if our own money is less, then our financial position is not that too good. Why, sir? Why our financial position? You must have studied in financial management also, right? If you are studying from my lectures or if you are studying from anywhere, that if you are having more debt in your capital structure, we studied about the chapter of capital structure. If you have more debt in your capital structure, what will happen? Your fixed commitments of the payment of interest will increase. That shows your financial position is not that good. Why? Because in case of losses also, you will have to pay the interest on debt, right? Whereas if you have more of equity, you are in a comparatively secured situation. Why, sir? Because it is your own money, it is the owner's money. You don't have to pay someone else. Even if you have the losses, you don't have the fixed commitment to pay someone else, right? Nobody is going to hang on your head. Nobody is going to keep the sword on your neck that please give our money, give our money, give our money. So that is why this says that if there is a fall in the prices, stock prices means the equity prices, reduction in the household financial wealth leading to fall in consumption, output and employment, right? So this was all about what? All about the analytics of the monetary policy, right? How the various monetary policy, what are the various parameters that impact the money demand, money supply in an economy. Now, in the next lecture, almost half the chapter is done. In the next lecture, we'll start with the operating procedures, which is again very, very important, very easy, right? Important but very easy. The CRR is there. What are the various instruments we are going to discuss about? The CRR is there, SLR is there, selective credit controls is there, then repo rate, reverse repo rate, LAF is there, open market operations, MSF. These are very simple things, very simple, right? Structure of MPC is there, functions of MPC, all these things are there. We'll go slow, but we'll be able to understand each and everything very clearly, very easily. These are very simple things, right? So I hope whatever we have done so far is absolutely clear to you. So guys, if any one of you is new to the channel, please do not forget to subscribe to the channel, and press the bell icon also, so that you get all the notifications. You're getting the whole course absolutely free of cost on YouTube. You just have to invest around 1,000 rupees in the books. That is going to give you a long-term return. So please go to our website. The website link is given on your description, in the description of the video also, and it is being displayed on your screen also. That is www.ksjteaching.org. Right. So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.